Hi there, this is another in the investment in shares series, and it's part 2 of the video on a new bull market. So I just want to expand on what I did in video 1 with a very important concept. So just to reinforce what was in video 1, this new bull market, which I believe has just started, will be quite selective. The big winners are going to be stocks that have strong future growth in earnings and/or the market is prepared to pay a higher earnings multiple for that particular stock. So it's as much about the perception of the future as it is about the current facts. And this concept of price earnings contraction and expansion is vital in understanding why prices can move so far in a relatively short period of time. So to my mind, the future stars are going to have price earnings multiples that are going to grow as well as the earnings growing. So that price earnings multiple is a key determinant of the price, and it's based on the perception of future earnings but also on the overall market sentiment. So when markets are very positive, then all stocks tend to have a higher price earnings multiple. But when markets are negative, then even the good stocks tend to have a lower price earnings multiple. So that's a very important concept to understand. Now, most Aussie stocks are going to struggle to grow earnings, I believe, in the next few years. But there will be a small number that will do extremely well. So I want to show a couple of examples. One of a stock that is in a sector, the retailing sector, that's really struggling, and another stock that's in a sector that definitely has the potential for great growth in earnings. So let's start with looking at the retail sector first. And this is JB Hi-Fi. And I'm very much on public record at the end of 2010 in saying that the retail sector was going to experience a significant price earnings multiple contraction, just as the media sector had done in previous years. So if we have a look at JB Hi-Fi in the 30th of June 2010, and at the time they generated earnings of $1.08 per share. The price was $19.07, and so the price earnings ratio was 17 times. So in other words, you had to pay 17 times 1 year's earnings to buy that stock. Now come forward to June 2008, earnings haven't grown. They've been basically flat during that period, but the market has decided they don't longer wish to pay 17 times earnings because the earnings are not growing, and so the market is only prepared to pay 8 times earnings. So as a result, the price dropped from $19.07 to $8.86, even though earnings came in the same. Let's roll forward to the projections for 2013, and if we assume that earnings are going to stay about flat, which is what the consensus analyst forecasts are at the moment, and that the market is still only prepared to pay a multiple of 8 times earnings, then we can expect to see the price stay around about the same level it is at the current moment, maybe a little bit lower. But what if the market decided that retailers were really out of favour and they didn't want to pay 8 times earnings anymore, they only wanted to pay 6 times earnings because of negative sentiment towards the sector? So for the same earnings, even though the earnings have not changed, the price could well drop to $6.18 if the market perception about future earnings changed and the market willingness to pay for those earnings. So this has been the outcome for JB Hi-Fi. So you can see that the share price was up around $23 and it's dropped all the way down to be below $9 at this point in time. So that's the direct result, not so much of earnings having collapsed. In fact, earnings have stayed stable, but in fact it's the market perception that has really impacted this particular stock. Let's look at Troy Resources, which is a gold producer, and this is common for a number of gold producers, and they're coming back from being significantly undervalued. So in June 2011 they made 16.5 cents per share of profit, and the price was $3.48. That meant they were trading on a price earnings multiple of 21. Now that's fairly high, but the market was looking ahead, looking for the future earnings that they felt comfortable this company was going to make. So we come forward into June 2011, earnings have doubled, into 2012, earnings have doubled, or more than doubled to 34.5 cents. The price has gone up a little bit, but not too much, because market perception about gold stocks up until very recently has been pretty poor. So as a consequence, the price earnings multiple that the market was prepared to pay basically fell in half. Now, moving to the forecast for 2013. At the moment, earnings are forecast to come in at about 80 cents a share, so huge growth in earnings. And at the current price of $4.80, the market is saying, well, at the moment we're still only prepared to pay 6 times earnings. But now that gold stocks are starting to come back into favour and probably in a major catch-up phase, it's very likely that the market perception about what they're prepared to pay in terms of price earnings multiple will increase. So what if that just increased to 10? What if it just increased to the same level that this stock operated at just a few months ago in June? At the same level of earnings of 80 cents a share, that now pushes the price up to $8. Now you might think from $4.80 currently to $8 is an awfully big step, but all we're talking about here is the market just maintaining the price earnings multiple. Now what if the market got really excited about gold stocks over the next year and decided to pay 15 times earnings? Then you can see where it is that the price can go. So this concept of price earnings multiple is just so important in influencing the way that share prices move around. And as a consequence, this is what the share price for Troy Resources looks like. It's heading up, and the chances are that the trend could in fact accelerate as those earnings grow and the multiple that the market is prepared to pay grows as well. Now, just a word of caution. The trend for some selected stocks will be strongly higher as their profits grow and as the multiple the market is prepared to pay also rises. So I've explained that. But along the way there will be corrections and there will be volatility. So therefore you can't just go in and buy any stock at any time. It's very much about timing the market. And future performance is not guaranteed. For everything else, all the other stocks, this will not be a tide that floats all boats, I do not believe. I don't think in this bull market we're going to see stocks across the board screaming higher. It's about where the strong odds are, and as I said, there are no guarantees. Now just a reminder, this is general advice only in all these video series. So what should you do now if you're just starting? Well, my advice is to get started now, because the trends are already underway, and when you get in early it really does amplify your overall result. So what do you need to do if you're a new trader or a new investor? You need a clear game plan, you need well-researched information, and you need an element of support to learn how the game is played. Now, in terms of ongoing information, you can either join our channel or you can go to our website, specialistshareeducation.com.au, because there is a lot of information there. There's going to be a lot more information come onto the site, and I know that I can help you a great deal in understanding how the market operates. That's all for now. Cheers.